Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 12th, 2023. It is 10:26 a.m. Eastern Time, so I'm starting the video, so we're about an hour into the trading day, and I want to do a brief update on the equity markets. This one will be more brief, at least a lot more brief than yesterday's video. That one kind of dug deep into the long-term charts, short-term charts. Really no change in the technicals. We're almost flat today, as of right now at least. And I'm going to do this one a little backwards. I'm going to start out with the inflation trade, and my proxy for tracking it. And I wanted to speak to this. So this is the economic calendar for today. I always encourage you to go into the site under on the home page of the site, the top menu under resources. Click that. Tools of the trade down on that bottom of the page has a link to the economic calendar, so you can get a heads up for the big market moving events, and they're usually color coded so you can see the ones that have the potential to move. So yesterday I mentioned the CPI would be out today, and that's the consumer price index. That's a measure of inflation. And I looked at the charts last night. I'll get to that in a second. And it was late. I go over the charts every night. And it would have been moot. I do this. Been talking about all year, actually, or over a year now, how you can pretty accurately predict where the CPI is going to come in. So again, it was late, and I figured it's not worth a whole post. It wouldn't have changed anything for me, but I was going to tell you, or at least after looking at the charts, I realized we were going to have a more bullish than expected, a lower than expected print on the CPI, and I'll get to that in a second. Again, I'm not trying to give you hindsight analysis. This is something I've covered before, and again, it wouldn't have changed any positioning for me anyway. So the CPI came in relatively benign, well below expectation. The consensus, these are little numbers, but it's month to month, and it's what moves the market. Consensus was an increase month over month of 0.03%. With a range of 0.2 to 0.4, and we came in at 0.1, so below the consensus range, and of course below the consensus number. The year over year printed at the consensus was 5.2 and came in cooler. So initially that caused, as one would expect, a big spike in the market. So its future shot up over 1% right on the print. Again, that would be surprising me if that wasn't the initial reaction, but so far we've faded almost all that. I'm going to get to that in a second. So okay, so why again, I'm sorry I didn't share this with you. I wouldn't have traded it anyways, but why did I expect the print to come in soft like that? It's simple, and this is again something I've been sharing for over a year now. What I call my real-time inflation indicator. It's something it's super simple and super effective. Inflation, what is inflation? Well, it's the cost of goods and services. Now this one obviously doesn't include the service sector. It doesn't include employment numbers, but it includes about everything else. And the things that really hit our pockets the hardest are energy, and that's in here. And this is my go-to proxy. There's various commodity indexes out there, ETFs that track the indexes. And this one I think is one of the more better balanced ones as far as what it has. It's not too top heavy in energy. Most are. And remember, energy by far has the biggest component of commodities in the consumer price index. That is, it's gonna when gas goes up to $5 a gallon from $3 a gallon, that hurts everyone's pockets a lot more than bread going from, I don't know what bread is, a loaf is $2 to $3, whatever. And hence that's a higher weighting there. And like I said, we've been doing this all year. I have, and from time to time, giving you updates on DJP. And let me find the board. Okay, this is the board I'm using. So there's two takeaways from this. I box these in. These are your monthly readings, and here's the most recent. And the takeaway number one is you can do a pretty good job of anticipating what the increase or decrease in inflation was. Again, this doesn't include real estate. It doesn't include the service sector. And right now, I do know that the Fed is more concerned about the jobs market than they are commodity prices. We all know that commodities have been trending down, until recently. So what I did here is I did back in the past when I've done these updates before and predicted where we're going to see the inflation print is just look at DJP. And so the box here, I put the box to, this is the candle right here. This is a March 1st candle, and there's the March 31st candle right there. And so you can see, and so here's the line. There was a close of the previous month, February, and so they measure inflation. I looked it up once. It's throughout the month. It's not a spot measurement any one day of the month. They have all goods and services. They have a basket of goods and services they measure around the country, and all you have to do is kind of just eyeball and get an average. So we pretty much, after the February ended, we had 3 days where prices went up, commodity prices as a whole, aggregate, based on this index rose, and then they dropped sharply. And they spent the bulk of the month, if you put in a weighted average or took a pencil and a calculator and computed it every day on the close, you would see that the average is way down, somewhere down here, which is exactly what we had. We had more benign inflation. So anything, if it was only commodities, you would have had a negative print month over month. But there's other things in there, and again, that's where the market's trying to parse that data. So I just wanted to mention that. Now, so that's one thing that can give us, if you were just gambling or betting Fed fund futures or even the stock markets because they're so hyper focused on the Fed. Again, this thing is pretty dang accurate. You can just look at this, and I've done that in the past. But now the other takeaway, and probably as if not more important, because I don't try to game the CPI. That's just not my thing. I'm looking bigger picture, turn on all the lines, and it shows that you can go back as far as you want. Here's 2008 right there. I've talked about this many times. That was a vicious bear market and an unusual bear market. The Fed kind of has turned the financial markets kind of topsy-turvy on their head and distorted a lot of things, and one of those was commodities had a vicious bear market between the peak in 2007 and into the COVID lows. And as I made many times, and not just this index, many other ones, we're in a new bull market. That's my take. That's not just a hunch. It's by every technical measure. And that's this is the whole commodity inflation trade. This is where Powell was denying, temporary, transitory, until he finally pivoted. And this thing, nothing goes up forever. So commodities corrected, and it has the Fed high-fiving themselves, thinking they've put an end to it. And as I said, it'll just be a vicious cycle, in my opinion. And that's where the bear market rallies, and the stock market will come from abatements in inflation, which we've seen. Once it became clear to most that there was inflation was abating, inflationary forces, you saw the market rally that we've had since really the October lows. And as I've stated, this appears to be a correction that has most likely run its course based on many metrics. You can include, let me put up some fibs here just for fun because I don't have any here. There was a 32% retracement. That is a typical, we're a little over 38.2, I'm sorry, 38.2%, typical run-of-the-mill correction, and appears that way by every metric that I can see technically. And you had this, this divergent low right here, big positive divergence, and it says most likely we'll get another leg up in inflation, and then my vicious cycle negative feedback loop will continue, which is a feedback loop between interest rates, real or perceived. I throw that in there. Doesn't matter if it's actual increases or perceived or decreases. Remember, the market in the last month, since the last FOMC meeting, had a complete 180 what the Fed was saying in the Fed's dot plot versus what the federal funds futures were saying, and that they gave a boost to this rally. Beneficiary were growth stocks, the big tech stocks, and so once the market starts to see otherwise, that's most likely that's the fundamental catalyst. So this whole negative feedback loop, right or wrong, it's played out so far, and that's fundamentals. But technically, this tells me commodities are likely to resume the bull market that they're in soon, and and that's where we're likely going. So crude oil is one of the biggest, and that one I also highlighted recently, having hit that when we peaked all the way back here, laid out this swing target of 558 final swing target, really a soul at the time. We had little micro targets on the way down, but 58.60 and the uptrend line right there, the uptrend line being that one, it was hit right there, we bounced, but then we went on to take out that uptrend line and hit the 58, almost 58.58 to be exact, almost to the penny there, hair under, and you can see that. And boom, we've rallied. We've taken out the downtrend line. We're at resistance. I'm going to say that right now. I don't have a position in crude. If I had to guess, probably a pullback, maybe back test here. Maybe, maybe not. I don't know. Again, when I don't know or to have a strong opinion, I just stay out. You know what, I might as well look at it for you on the 60-minute chart. Here's the 60-minute chart. There was a downtrend line right here. This was that big pop on the OPEC plus cuts, and that took us above that downtrend line. And here's an uptrend line. If we do correct, we're starting to diverge here. You can see some divergence. My guess is probably rein in a little bit, come down some point, hit that trend line, and then maybe resume the uptrend right there. But either way, see what's happening right now is and this is what I wanted to talk about. This is why I'm doing the video right now. So the market's high-fiving, or at least initially this morning. Let me show you the futures pop. We can see it actually on QQQ. Let me just put on the 1-minute chart. Go to the pre-market trades. Let's do that. Right-click, edit chart properties, pre-post data. Always show last 2 sessions. So these are the people that read headlines and react to the news, right? I've always said, by the time you read something, it's usually priced into the market. But there are always those people that will react and, oh my gosh, inflation came in, CPI came in well below expectations. Market's going to explode. Fed's going to be, they don't have to raise rates anymore. They're going to start cutting rates. And no, the reality set in. So those people that bought the news, a lot of those are algos anyways. Computerized trading programs are fast when people, they jump on, they parse the headlines and fire off buy programs based on certain words and information. But they've faded 100% of that rally and then some. So I just wanted to reiterate that's if anything a shorting opportunity when you see things like that, because nothing, and I'm going to segue now or roll into the equity market charts. I'm not going to spend a lot of time because I did a pretty in-depth video yesterday. So let me just turn that off, and let's get to that right now. So 60-minute chart, QQQ, zoom in nice and tight. That was our recent divergent high, breakdown, back test of the uptrend line. We're just kind of bouncing between this level. I've said it repeatedly. I know I sound like a broken record, but our next sell signal in objective short entry will come on a break of 313.62 right there, give or take. Redder the better, I like to say. In other words, if you're going to short an intra-period break, the farther we get away from it, the more likely you're going to get that solid close, and a solid 60-minute close would help solidify that sell signal. And you look at the daily chart, QQQ, you have, let me go to a cleaner board here, you have that's a big level there. Remember, that was my max top of my most likely bounce target zone. We entered my max bounce target zone, and it was there because that's also price resistance. It's not just, it wasn't a random level initially set. It was set back here before we even got up there, and then we had additional reactions on it since that helps further validate that, in my opinion. So on the daily, I have it at about 312. So you look for you want to see for the bearish case, that is, you want to see a solid break, and especially a big red close below there, and then that will help confirm it. The other thing I'm watching for, which continues to firm up, momentum continues to wane. What I mean by that is when you're going up, this is a momentum indicator, the PPO, as is the RSI, and momentum is clearly waning. That's what negative divergences are about. They're a big part of my trading, and so when you're going up, especially the stronger the uptrend, and you don't have to go down to turn the momentum indicators down. You just have to, the rate of change, the rate of ascent has to slow. And so and I've heard this lately, bulls are saying, well, they're buying the dip aggressively, market doesn't want to go down. Okay, anything's possible. I'm not going to sit there and tell you, as I always say, hey, maybe I'm wrong. Maybe maybe this is just consolidation to work off the overbought conditions. That's what a healthy rally entails. There's always, as I like to say, there's two ways for prices to correct. They can correct, or security to correct when going up. It could correct in price, meaning it goes down. That's a correction, or it can correct in time. Or a combination of a little bit down, but mostly sideways. The correction in time is the more bullish of the two, so I'll acknowledge that. It means buying pressures are stronger than when you have a correction in price. So, yeah, maybe we do that. However, that's also often how tops end. Sometimes they just go up, 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 and then you turn. And was the case right there in that rally. Here you can see we rallied up and had a little kind of momentum was waning, and then finally you had a correction there. Here you did the same thing. You corrected in mostly in time, a little bit in price, and then finally went down and corrected. So they can happen either way. But like I've been saying, this may not pan out, but this is the best. One of, at least in the past year, the best bearish setups I've seen technically. These negative divergences. We haven't had that since the bear market started. The last time we had negative divergence on the daily chart of QQQ and all these market leading stocks was right here, leading up to the top, the bull market highs in the Nasdaq back in mid-November right there. Negative divergence right there, pretty much double topped at that point. And so you had divergence at that first peak, little correction, then an roughly equal high, and that started the whole bear market. So this is one of the better divergences I've seen, and by the scope of that divergence, the facts on the daily, again, this is just me as of now, and maybe this changes, and I'll let you know. I'll do my best to convey my thoughts if and when they change. I'm not looking for a 5% pullback or 3% pullback. We'll get that. We'll have bounces along the way. It's not a straight down move, but I'm looking for a 20% or so drop in the markets. And today, my convictions are higher than they were a week ago. Why? Because as PPOs continue to roll over, and the cross is now appears to be imminent, in my opinion. And based on just the posture, this is Apple again, one of the big dogs. Oh, by the way, guys, I did this for you. I talk about this all the time, but just to give you the facts, I kept I've said over the years, I've been following and trading QQQ for many years, and I talk about how just the top handful of companies are all you really have to track. And in this case, I went in yesterday into Invesco's website. Invesco is the ETF operator for QQQ, and I pulled the weightings on each company. And so yesterday they had the data through March 10th. That's going to change on day-to-day basis. But the top 6 companies: Microsoft, Apple, Amazon, Alphabet. There are 2 share classes, and both GOG and then GOGL, class A and C, I think it is. Meta, and it's one company, and Tesla. They equal, those 6 companies, Meta, Tesla, Alphabet, Amazon, Apple, Microsoft, account for over half of the gains in the Nasdaq 100. So again, don't overthink it. It doesn't matter what the other 94 companies do. All you have to do is figure out if you can get a good idea of where these 6 companies are going, and they have a high correlation. They tend to move together because of indexing. It's really, people are of course buying these companies, but more people are buying the index, buying or selling the index. And they are also the top components of the S&P 500, just not to such a large extent. So that's that. And then when I go through them, you can see here, Apple was always the largest, and oddly enough, Microsoft was just a hair larger. But Apple is 12.25% of QQQ, and again, this is by far the best looking short setup I've seen on Apple. So again, I'm just reiterating my outlook. And letting you know that as strong as my convictions are, despite the resiliency of this uptrend, which means nothing to me. Again, I've talked about that. The same folks right now that are just cross-eyed bullish and saying there's no way this market's going down, they're buying the dips too aggressively. Oh, I mean, what were you thinking right here? Apple was going up in a much stronger rally. It's straight up and then just turned on a dime and went nearly straight down. Same thing right here. Look at that. If this is recency bias, it's just the belief that because something's going up and it didn't have a single red candle right here, that whole run until it just had one, and then they just kept coming. And that's the nature of especially a bear market. The volatility spikes up, the machines, the algos, they turn, they decide, okay, we've been buy, 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 buy. They're in buy mode, buy programs, and all of a sudden those programs quickly and collectively turn into sell programs. So maybe, maybe not. I'll tell you, when it comes, look at that beautiful uptrend line. Apple needs to break that, and a nail in the coffin will come on a break under 157.50. Where do I start to second guess that? Well, certainly going to help the bullish case and hurt the bearish case if you take out the downtrend line there. You're also going to take that previous high out. It's not going to eliminate it, but then it would be another check mark for the bulls, X for the bears. If the divergences are no longer in place, that's pretty bullish stuff right there, and that's where I start to shift. A recent example was gold. I was, and I'll get to that in just 1 second to wrap it up. I've been unwaveringly bullish longer term since since gold bottom back in, what was it, late 2018, early 2019. Whenever that bottom came, and then trading corrections, shorting corrections, but longer term bullish. And recently I had what I called a soft pivot, and it was basically because my outlook for the stock market, the euro, and gold, all three of which really it's the U.S. dollar. You can flip euros to dollar upside down. The correlations on the larger trends, it just didn't make sense, and one of those may disconnect, and that's why I called it a soft pivot on gold, not a hard pivot. In other words, that for the stock market to do this, we're going to have to see the dollar and the euro fall. The euro, you can here, I'll put it up. Probably going on tangents like I always do. Let's see here at a chart properties comparison. I'll do an ETF. If I do Euro US dollar, it shows around the clock trade. So what you want to pick is we'll do UUP. There's the US dollar. Turn off IEF. And then let's compare it to the stock market. Let's look at the Qs. That's where the juice is. So you can clearly see, especially and most importantly, because that's the current trend, since the market peaked. All right, the market peaked back here. That's the stock market in white, QQQ. And you can see when the dollar, which is in green, is going up. And let me just do this, guys. Let me just edit chart properties. We'll just invert the dollar to UDN. That's the dollar down, and now you can see the correlation. This is, I think, helps people that aren't wired that way to kind of see correlations instead of inverse correlations. You can clearly see. So therefore there it is. So and then gold also has its strong correlation to the dollar. At a chart properties, we'll also compare gold, and you can see that. So they're all kind of moving together. So this would imply that if UDN, which is in green, goes down, that's the dollar rallying, and that would mean these all come down as well. And now the relationship between any two of these can disconnect, and it can disconnect for a period of time, but it's hard to argue right there. This has been the trend, and look again at the major peaks. Don't look for the lines to overlap. They're priced in different increments. Gold and the dollar, and especially the Nasdaq 100, they move in different percentages. The dollar has the smallest percentage gains in daily fluctuations and trends, and the Nasdaq's the largest. So that's that. Let's go back to just the components of the Nasdaq 100 so I can just show you where they're at. So there's QQQ, 12.2%, Microsoft, actually again, QQQ just a hair bigger, 12.71. I mean, just that one stock makes up 13% of the Nasdaq 100. And again, when I look at it, I see Microsoft had divergence. The last time I had a divergent high was right there. and it dropped by, it was a small divergent high, and it was also coming off. That's a 15.5% drop. It was coming off the heels of the first divergent low since this one right here. So that's, that was a pretty powerful big divergent low, and so that gave us that divergent high, gave us a correction, but that correction was still 15.5%. So here we are again with an even bigger divergent high, something that's more comparable to what Microsoft had when the market topped back there. And again, that's going to be a big impact on the Nasdaq 100, and to a lesser degree the S&P 500. Alphabet, both share classes collectively add up to be 7.6% negative divergence, pending bearish PPO crossover. So we're there. The divergence, I always say, is not a timing indicator, but I always give you my thoughts on things. This PPO crossover looks imminent at this point, and it's kind of nice that we had that little extra thrust up in in Alphabet. You know why? I always kind of equate technical analysis or the case to be bullish or bearish or long or short. I equate it to a criminal trial, a jury trial where you have to, the prosecution has to build up evidence, and the more evidence they have, the stronger their case is, the more likely they are to get a conviction. Well, of course, they have to have enough to even bring it to trial, right? And so the same thing in technical analysis. So I'm going to be bearish on the market. The more check marks I get, especially among these top 6 that I just showed you, because that's all I need to know, where these 6 stocks are going. If I'm right on this, then I'm right on QQQ, and it's easy. I can put a bunch of money in NQ futures, and I don't have to worry about picking the wrong FAANG, the wrong tech stock, and then they happen to be the one that blows earnings away, or the market responds positively, and the rest tank. That's the, it's a whole safety in numbers thing. And so again, QQQ or NQ, Nasdaq 100 futures, are really just these handful of stocks, is what it is. Everything else is just going to follow due to the program selling and buying, and so there it is. So where I was going, I'm sorry, I got off on a little tangent. That was a lower low from that previous one, so there was no negative divergence there, and it looked like we were going to have a bearish PPO crossover, but we didn't. The PPO line remained above here. I think you can see it there on the. But now it appears imminent, and at this time, if we get it, or when we get it, we'll now have negative divergence, because we made that little last leg up, that little gasp of air, that little sucking in more longs, blowing out more shorts, creating more bullish sentiment, and that just sets the stage for an even bigger drop. So let me put a little trend line there. Here's your charts. Amazon, well, no divergence, but really doesn't need it. You had a nice island topping candlestick right there. That's an island top. It's a gap up, separated by a gap on both sides. A candle after an uptrend, separated by a gap on both sides, and also not hard. I'm sorry, I'm being a little dramatic, but a rejection off the this downtrend line. That's a pretty nice downtrend line. It comes back here, cluster of reactions there, distinct reaction there, and boom, and the 200 days. So, I think that's it. Oh, and of course, like everything else, pending bearish PPO crossover. You put up the histogram on all these guys, you can see it. Amazon, by the way, 6.2%, if I didn't mention it. Actually, we've got the crossover there, bearish PPO crossover on Amazon. Last time we had one was right there, and the stock dropped from there roughly 18.2, call it 18%, from that last bearish PPO crossover. Had one right there, had about a easily double-digit drop, had a nice bearish PPO, and I always say these are what I call hills. Big green hill. The bigger, the more distinct the hill, the better the crossover signal is. Look at that one there. If you shorted that bearish PPO crossover and rally into the 200-day moving averages, you were good for. If you held it to the bottom, you made about 42% on that short trade on Amazon. So those are things you look for in a bear market. And if you believe the bear market's over, then guess what? I'm showing you levels to watch. I'm showing you support levels. Like I said, buy those levels. And I'm not being sarcastic or facetious. I mean, buy those levels and just manage your stops. That's you should be looking at it the way I'm looking at it in reverse. where I'm looking for a break of 313, 312 on QQQ for the next objective short entry or add-on. That would be your support level, and then you might say, well, okay, I don't agree with Randy where the market's going, but I agree that's good support, so you buy pullbacks to 312 with stops somewhat below. And if that doesn't work, maybe you're taking a longer term approach and you say, okay, maybe we'll get a little bit heavier correction, but I'll buy the 200-day moving averages. Whereas I'm looking for the 200s to get taken out, and that's going to be a very, very bearish event because I've heard numerous bobbleheads on TV and elsewhere citing the fact the markets are above their 200-day moving averages as longer term bullish, a rally that's going to carry for months, maybe years, and maybe they're right. I fully acknowledge that's usually on a bear market the indexes get rejected and remain below the 200s, but there are instances where they go up, and again, nothing would set the stage for a better bull trap than a breakout, which we've had in a solid recovery of the 200 days, successful backtest, but then to see them go on and fail. So this is where, in other words, another way for me to put that is, let me turn off all the lines. At this point, if we get that, we're just going to have a correction, and some of those longer term bullish folks, and they may be right, will make the case it's okay, we got ahead of ourselves, tech stocks are overvalued, blah blah blah, whatever reason. And that would be another buying opportunity. So they might acknowledge, market maybe needed to correct. And but if those levels give way, if these reaction lows back here from early March give way, the 200s are clearly taken out. Oof, that's where the waterfall selling will most likely start, because you will see institutions, professionals, individuals, a lot of folks. That'll be what I call a point of recognition, where there'll be a rapid paradigm shift in thinking in the market, that instead of this being start of a end of the bull market, or just another check mark in a new bull market, and with this being the end of the bear market, people will then collectively rapidly probably start viewing the market the way I am, that hey, guess what, this is probably, we're going to take another leg down, and then they'll be talking about another test of the lows. I think it'll be kind of like Monopoly, the get out of, go to jail, pass go, don't collect 200, go right to jail kind of thing. I think we'll probably blow right down through there. There'll be a little bit, the algos are going to buy a test of the recent lows undoubtedly for at least a little bit, but I'm getting ahead of myself, guys, because that's what is that? We're talking, that's almost that 20% we're talking about there, but I think we're probably going to undercut that and have very little reaction. Again, I'll let you know my thoughts if and when we get there. That's 20% away. But let me wrap it up here. So that's it. In a nutshell, I wanted to let you know that no surprise, based on my real-time inflation indicator, that inflation numbers came in soft. All the better that I saw that pre-market pop. I turned the pre-market trades off. It was much higher. They ramped the futures way up, and then all those that bought that got smoked. So this is where you're starting to see, and this is what I like to see, where the kind of the market's reaction, in a strong uptrend or a rally. Good news is good news, and bad news is either ignored or shrugged off, or somehow spun into being good news. We've seen a lot of that lately, with the market twisting, like, for example, softer economic growth. Oh, well, that's going to allow the Fed to pivot and start cutting rates. I mean, hello, it's like that, Back to the Future, McFly, tapping on his head. Hello, there's no positive spin when the economic indicators start to roll over, increasing the chances that we're going into recession. That you want to spin it, however, that is the ultimate delusional mindset, I think, from bulls, that it can spin a recession or a turning economy as bullish because the Fed may become more accommodative. No, that doesn't work. Go back, I think it was in 2000, there was a instance, and I cited this in the past, and I'll try to dig it up, where the Fed, here, let me see if I can find that real quick. Okay, here's an old blog post. This predates right side of the chart back in 2017. I was subscribing to a subscription service, and one of only two people on the entire board. Everyone was foaming at the mouth, bullish all the way, and even the folks that ran this site, the two folks in complete 180 denial, claiming they saw the bear market. Anyways, that's moot. But up until well into almost the middle of 2018, still bullish, thinking we're in a bull market looking for new highs. Anyway, so what I cited right here is, and this was out of the Wall Street Journal. At an unscheduled meeting on January 3rd, 2001, the Fed cut rates by 50 basis points. The Nasdaq had its best day ever at that point, rising 14.2%. From there, the Nasdaq fell 57% after that first rate cut in 2001. In fact, investors would have done better as they held off to buying tech stocks until the Fed started raising rates in 2004. So my point is that what I'm trying to make here is that there's this misguided, and again, it's years, it's Pavlovian conditioning, if you will. Pavlov and his dogs with the bell ringing, Fed cutting rates, flipping, going easy. They tried it in 2018. They had started raising rates. Market threw a hissy fit exactly as I predicted they would, and exactly as predicted, the Fed pulled a 180 and then turned around, said, "We're sorry," and gave the market back the juice. Well, that's pushing on a string. You're having limited, and back then the economy was still in pretty solid footing. This time around it's different. So my take is a Fed pivot, real or perceived, meaning actual or perceived by the market, will most likely not do the trick. There's larger forces in play. The ship has turned. The economy is like a super tanker out in the ocean. It doesn't turn on a dime like a speedboat. It makes a slow turn, and that ship's been turning pretty clear. All the reliable recession indicators, the yield curve inversions, everything else is saying where we're going. So what's the takeaway? Well, number one, that I don't think a Fed pivot will do the trick. Number two, just like today, for example, because that CPI number, nothing was spoken by the Fed. The Fed didn't come out at 8:30 and say one thing or the other. The market assumed, because inflation came in below expectation, that the Fed would then pivot, or at least, and so the algos and everyone that bought, but that wasn't the case. So anyways, just keep that in mind. All right, guys, I'm going to wrap it up here. Went a little longer than I thought, but again, these are the things I'm watching, that feedback loop between inflation, and then at some point, I'll tell you what, honestly, I may back off that inflation outlook a little bit, because if things get really ugly here in the coming months, you could be looking at deflationary forces, and that's not good for the stock market, of course. And I'm talking a pretty heavy bear market, heavier than expected recession, because that's the other thing that doesn't scare me. I welcome you give me any market as long as I can see it coming, bull or bear market. But what I'm seeing, the general consensus seems to be still to this point either no recession, or at worst, and again, this is just, maybe I'm reading it wrong, but I look at a lot of sources, at worst, acknowledging, recession's probably going to come later in the year, fourth quarter, back half of the year, and it will be a mild recession. That is about, again, I know there's always outliers, the doom and gloomers and all that, but that seems to be about the general consensus in the market. And if it ends up being worse than that, it's not priced in. That is not factored into the market, and there's still all the systemic risks that I've talked about before that haven't yet materialized. So far, we've seen a lot. The trend to me is as clear as my hand in front of my face, and we've predicted it. Others have. We saw crypto with the first cracks in the market, the crypto exchanges and crypto funded lenders, and then the banks. And I posted that little meme when Silicon Valley went down, that Credit Suisse was next. Sure enough, what was that, a week later, 2 weeks later, three, after posting that meme with the little Grim Reaper coming knocking on the door, Credit Suisse went. Everything is falling into place. And again, these things don't happen overnight, but that's the trend. The fundamental, the macro trend, to me, has clearly been rolling over as predicted, and I don't see any change in that. And so All right, where are you going, Randy? You're rambling. Well, huge opportunity here, I think. If the market, has greatly mispriced. And again, it was technically induced, big divergent low there, excessive bearish sentiment. This is big picture stuff. This is why I try to always loop back to these long-term charts and paint the big picture. I just don't think enough people look at the big picture. People get impatient, and like I said, where I differ from, I think, probably just about, or at least everyone out there that I listen to, I'm taking a much longer term view. I think this bear market is going to unfold a lot longer and slower than any in recent history, and that's where I think a lot of folks are figuring, okay, well, that was about, from high to low, that was about what we had in 2000 to 2002 bear market, and the 2007, October of '07 to March '06 bear market, roughly, give or take, if you count that as the bottom right there, January, about 1.2 years. Now, again, this to me is just early stage bear market action, most likely. And again, I will pivot. It'll probably be a soft pivot at first, at some point maybe a hard pivot if I'm wrong. And I already showed you what, talked about what I need to see to convince me I'm wrong, starting with but not limited to divergences getting taken out on the 60-minute charts, support like this 313.62 holding. Bulls have had several attempts. They've come in and bought as expected, but you can see there's no follow-through buyers. So all right, guys, I'm going to stop here, get it out to you, and I'll continue to hunt for trade ideas. I'm just having a hard time finding a lot of objective longs. I did share one in the comment section. This one right here, but it is a trade setup, not an actionable trade. It has to break 215 and the downtrend line, which come in together. I believe they just reported yesterday or today. I think yesterday, and they're down, but it's just looks like a nice inverse head and shoulders pattern right there, and that's your neckline. So call it 215 to be safe, and if it takes that out, all the better, because it'll take a downtrend line as well. But again, I'm struggling to find. I'm finding as I go through the charts more and more short setups. I was posting a lot of long setups earlier in the year, January, February, up until even March. And I just want to let you know that. So if I see something that stands out, this one looks good, but it's also a low price stock in a sector that's not been doing so hot. But I'll get those ideas out to you as I come across them. As of now, I'm just focusing really largely on the index shorts and some other side things that to round it out. Commodities and all that, keeping a little diversification there. Treasury bonds, I told you, short on those, and gold and silver, still short there. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.